We're going to see one of two scenarios happen in the stock market over the course of the next week or so. One is going to be good and one is not so good. Hi, I'm Doc Severson. Welcome to my Market Minute for Thursday, the 7th of April. Here's the S&P 500 on a daily chart, and after we've had this mid-March rally, which went for about 500 points to the upside, we've spent the majority of the last 7 days pulling back to the downside. So now, is the issue in doubt? Are we headed for much lower prices, or might the S&P 500 rally from this point? Well, guys, I've been doing this long enough to know that I can't predict what's going to happen, much less what's going to happen over the course of the next week. However, there are certain clues that we can determine from the market that let us know what is actually happening in front of us instead of relying on the narrative in the news or through social media to make up our decisions. The first tool that I'm going to use to understand what's going on across the market is what I call a triple pane fractal arrangement. So this is the S&P 500, and I've got monthly, weekly, and daily charts illustrated here. And each one of them has got what I call fractal energy down here. Now, this is the choppiness index, but what it does is almost generate a fuel gauge reading of full with very high values up here and empty with very low values down here. What I'm seeing at the monthly chart is I see a chart which has gone from range expansion to range contraction. It was in exhaustion and now is about mid-grade. So there's no lack of energy for this chart, and the trend is still fairly strong to the upside. This is just nothing more than a pullback to a higher low. That's the monthly chart. Now, the weekly chart was showing a polarity to the downside with lower highs and lower lows, and what happened over the past few weeks is a change in polarity with a higher low and a higher high. So we actually had a change in polarity back up to an uptrend over the last couple of weeks. Great. So now we get down to the daily chart on the right-hand side. Now, this 500-point rally was extremely linear, and because it was extremely linear, it takes a lot of energy out of a market, and we had an exhaustion figure as we got into early April. So you got to pay for that. Range expansion goes into range contraction. This is normally manifested by watching the price either go sideways or down or somewhere in between that, like this. So it's very common to see markets get a strong short covering move to the upside and then have to rest for a short period of time. So imagine if you were to climb up the side of a mountain and try to summit all in one day. Could you run up the side of a mountain? No, not without getting completely winded, grabbing your sides, and probably resting for a short period of time before you feel ready to assault the mountain again. And this is how markets move. They move from range expansion to range contraction. And right now, we're in a range contraction mode. So let's dive into this chart on the daily chart with a little bit more detail. We're now back to a single S&P 500 chart. Again, you can see that initial impulse move and then the retracement or correction back. So now we need to do a little bit more framing, and we're going to use Fib retracements for this. Fibonacci retracements. We're going to start at the beginning of this swing back in mid-March and up to the top, which was just a few days ago on the 29th of March. When we draw Fib retracements, we can see how much of the initial swing it retraced. So here's a number that's 23.6. Here's a 38.2% retracement, which is this price level here at about 44.40. Here's a 50% retracement, 61.8. And now we've kind of framed things in. So here's the standard rules. When we have an initial impulse swing like this, very commonly the price will come down to the 38.2 retracement. That's very normal to see. Oftentimes we'll also see it come down to the 50% or as far as the 61.8% retracement. Now, this represents kind of the last line of defense for the bulls to have an argument that this is still an uptrend. We've seen this before. We've seen markets do the initial swing up and then pull back to a 61.8% retracement and then recover nicely from there. In fact, it generates so much bearish sentiment down here at the very bottom of that 61.8% retracement. You could make the argument that it actually increases the rally from there. So guys, scenario number one is that this is just a common retracement and we should expect to see the price bounce and resume the uptrend at either the 38.2, 50%, or as deep as the 61.8% retracement. So that's the good scenario, is that the price is just retracing for right now, and we're going to see this assault the new highs or the relative highs in short order. However, that's not always the case of what happens with these patterns. Here's the second scenario. This is the alternate scenario, is that we do get some type of retracement and we start to see the price execute a recovery rally from there. And so at this point, everybody is going to be relaxed and say, okay, this is all great. We have our 38.2% retracement. The price has rallied up from there. And then everybody's assumption is going to be that we're just going to go ahead and fill this gap and then reattach ourselves to the all-time highs and the S&P 500. And that's certainly one train of thought that's out there right now. The danger here is that everybody gets complacent as the price rallies up from wherever bottom that we're going to put in the next few days. Scenario number two would be is that we do bounce from the short-term bottom, but then all of a sudden what happens is the trapdoor opens up. And this can become very, very violent. We actually have a good example of this over here back in January, where everybody expected the price to bounce back up and keep on going as it had done for the entire year before that. And then what happened was the trapdoor opened up. Nobody expected this. Well, I would say few people expected this, and we confirmed it as the price undercut this trend line as well as made a new low, and that creates a lower high. Now, the danger here is that this would create a massive monthly lower high on the chart, and that's a very, very dangerous technical signal, which it may not recover from until such time that it's already gone down 20% from the highs. So if we do see something like this, this is scenario number two. This is going to be very dangerous. You need to be on your toes to make sure you don't get caught in this potential bull trap, which may occur sometime over the next week. Let me know in the comments below if you see any other possibilities that may hit the markets in the near term. Thanks for listening, and I'll see you in the next Market Minute.